We are on the edge of a stock market crash. The economy is slowing down. Economic indicators that we've been getting have been saying that there is a slowdown in growth. Stocks are overpriced, and because of that, we will get a stock market crash. Despite that, there are stocks to buy now. And I wanted to break down looking at how the stock market crash will occur and why these stocks to buy now will actually move higher over the course of the next, say, 3, 6, 9 months. Interest rates have been pushed very high in order to contain price pressures. This is slowing down the economy. With growth rates slowing down, the stock market will crash. With a stock market crash, though, all stocks move down except for those kinds of stocks that don't go down in that type of environment. That's where the stocks to buy now are. Let's jump in. I want to break down the economy, what's going on with the stock market, why the stock market will crash, and what are the best stocks to buy now. Let's jump in. If you're just joining me for the first time, first and foremost, I am an economist and have been working professionally as an economist since the early 1990s. I look at the stock market driven by economic indicators. I ask the question, what's going on with the economy? Because of that, what will happen with the stock market? And what we're looking at is a stock market crash. And again, towards the end of this video, I'll break down stocks to buy now. I am moving into one of two stocks to buy now. This will be a major position going forward in the next 3, 6, 9 months because with a stock market crash, these stocks are already at the bottom and will bounce higher. That's when I plan on making those profits. They're kind of locked in. I'll explain that in a minute. But what we're looking at right now is the personal expenditures versus PCE deflator. Now, as an economist, looking at the economy, asking the question, what's going on with the stock market? The stock market itself is actually an indicator based on the economy. We get personal incomes, personal expenditures. Those expenditures, individuals spending money in the economy turn into revenues for businesses. Guess what? Incomes and expenditures are slowing down. And in this case, we're looking at personal expenditures versus the PCE deflator. Now, the deflator, we got this about 2 Fridays ago with personal incomes and personal expenditures. What are these? Personal incomes, the total amount, aggregate amount of income being earned in the United States by individuals. If we get more people being added to payrolls, more people getting hired, that will increase the year-over-year rate of growth of personal incomes. What do people do best with incomes? They spend it, expenditures. So you earn it, you spend it. This generates revenues for businesses. But what we're looking at here is also inflation. This is the root cause of what the Federal Reserve has had to act upon. Inflation spiked high because of numerous things going on with COVID. You had the supply chain breakdown. You had interest rates pushed down to ultra low levels, and that pushed a housing bubble. That housing bubble created price pressures for housing. Federal Reserve stepped in, pushed interest rates up pretty quickly. That's all coming downward. We'll come back to a chart similar to this, but I wanted to take a look. This is the short-term interest rates, the overnight rates, sitting about 5.33 as the effective rate for the Federal Reserve's short-term overnight rate. The effective rate. They target a range between, say, 5.25 and 5.55. The effective rate, of course, being 5.33 right now. This is a look going backward to early 2000s, but the same chart moving way back. This is pretty high. You see some big spikes from inflation back in the 1970s and 80s, things that I remember. We had some inflation pressures back in early 2000s, and the Federal Reserve pushed interest rates up there. Then that was also a housing bubble. We saw a big recession with the 2006 housing bubble when that popped with interest rates moving as high as it did. I don't necessarily know that we're going to get a recession right now. A stock market crash, Very likely, very, very likely, because of the rate of growth. Non-farm payrolls just hit Friday. And as you can see, not a whole lot of new jobs being added. Here's the thing with non-farm payrolls. And I'm going to break these charts down for you real quick. This is the civilian labor force. The total number of people in the United States that the federal government believes wants a job is working. So the civilian labor force, there's two individuals in there. People that are working, people that are not working but want a job. That's the labor force. The number of unemployed, here you can see these charts starting to move a little bit higher, but there's a little thing there. If you don't want a job, some people don't, you don't get counted in the civilian labor force, nor do you get counted as being unemployed. So that's a real interesting distinction for those of you who don't look at these kinds of numbers on a regular basis. The number of unemployed versus the civilian labor force is the unemployment rate. But what I wanted to know, I put all those charts together because I wanted to ask this one question. Price pressures are moving really high. Families are really getting hit hard. You can see there was a big spike up in the civilian labor force as a percentage of the total population when COVID hit. Since then, it's been moving lower and lower, even though price pressures have been moving higher and higher. So the civilian labor force has actually been shrinking relative to the population, those that want jobs. But we're not talking huge numbers. We're talking about 2 or 3 percentage points. That adds up. 2 or 3 percentage points off of what? 330, 350 million individuals? That adds up. That's about 7 million individuals. So that was something I wanted to ask the question, but here is where, as an economist, where I start to look at the economy and ask the question, stock market crash, what's going to happen here? Personal incomes versus personal expenditures. Individuals earn it, then they spend it. This is the rate of growth of personal incomes versus personal expenditures. And as you can see, incomes have been trending higher after a recent move downward. They hit about 1.25. Personal incomes, of course, being the green button here, or green line. Incomes is where it's driven from. Now, government expenditures are pretty flat lines, so you're not going to see big spikes from that would drive the economy too much with government expenditures, although we did have the Inflation Reduction Act, and that did create stimulus and will continue to do so, but we're seeing a waning effect from that. As incomes, so do expenditures. That turns into revenues for companies. We're seeing a slowdown. We're not seeing the peak that we saw before. Because of this, stock prices in the stock market are overvalued. This will begin the process of a stock market crash. If we don't get any more growth in incomes, which there's no catalyst for that to happen, that will begin to get people to start selling stocks, the beginning of the stock market crash. At the same time, expenditures are starting to slow down. The effects of higher interest rates are starting to really hit incomes and expenditures, which drive the economy. This is the beginning portion of the economy. Businesses will respond to that by laying individuals off and not moving forward with some business expenditures. We're starting to see some stocks reporting some really negative numbers. Starbucks. Personal expenditures versus GDP. We got the GDP, what was it, Tuesday, Wednesday last week? GDP, as you can see, is starting to really slow down. And as you can see, personal expenditures really drives the GDP number. They go hand in hand. Expenditures are slowing down. That's the blue line, by the way. GDP will follow. We will see slower growth rates. Those slower growth rates will be the beginning of the stock market crash because the stocks have been chasing yield, pushing yield prices really high versus what these companies will be getting in the next few quarters, 4 quarters. But these companies are not going to be able to get the revenues that they're looking for because interest rates are not going to be able to move lower. the Federal Reserve is going to be stuck sitting where they are with the United States presidential election November 5th. Consumers are going to be strapped with higher interest rates for longer. Fed's not going to want to look like they're swaying the election one way or another. They're looking at inflation. They're looking at employment. They're sitting on their hands. Those higher rates will mean lower growth for companies. Prices will follow stock market crash. Here is a look at SPX. SPX, of course, the S&P 500. I'm looking for ranges, say 3,500 to 4,200 in SPX, which is a pretty solid drop lower. And if you trade SPY stock, of course, you're looking at it's 10% of that, so you're looking at about 350 to 420. Those are big drops, but the yield that individuals have been chasing because of lower interest rates is no longer going to be there. Revenues are going to be missed by companies in the next 2-3 quarters. We've probably peaked just a couple weeks ago with SPX. Because of that, we're going to see a stock market crash as savvy investors get in quick and start hitting the sell button. But what are stocks to buy now? This is what I've been getting into. This is the opposite of higher interest rates. TLT stock, one of my favorite stocks to trade. We are at the bottom of a series. Now, for those of you who are not savvy with interest rates and price, all right, as price moves higher, yield moves lower. There's an inverse relationship between the two. Federal Reserve has pushed interest rates up as far as they need to go. Just Wednesday, Fed Chairman Powell basically said no more interest rate increases at this time. Price pressures are not where they need to be, but the economy is slowing. So the Federal Reserve probably doesn't need to raise interest rates any further. Their next move will be lower. If interest rates move lower, this stock, TLT stock, moves up. Now I'm in at 87.50 and 88 at this point. My expectation is I'll be exiting this around 125. That's a pretty solid move over the course of, say, the next 6, 9, 12, maybe even 18 months. We'll see how far that has to go. But from a standpoint of stocks to buy now, TLT stock, one of the most important ones. The Federal Reserve does not need to raise interest rates any further, and even if they did, it would be a small amount. And while the bond market may be toying with moving a little bit higher, for the most part, the bond market is about as interest rate yields are about as high as they need to be. Bond yields will move lower. TLT stock moves higher, making this and TMF stock, the two are pretty much exactly the same. TLT stock and TMF stock, stocks to buy now based on a stock market crash. Stock market in TLT stock or ETFs on treasury bonds kind of go inversely, all right? As the Federal Reserve pushes these interest rates lower over the course of the next 6, 9, 12 months, TLT stock, TMF stock, they move higher. I'm looking for prices of about 125 to get out of TLT stock in the course of 6, 9, 12 months. But the Federal Reserve won't be able to move until after the election, November 5th. They have a meeting November 6th and 7th. So there's time to build up this position. And I'm going to be talking about my position on TLT stock as stocks to buy now, simply because this will be a big move for those who are savvy enough to get in on this kind of stocks. It's an ETF on treasury bonds. Yields go down. TLT stock, stocks to buy now. Make sure to hit that like and follow button. I will break down what's going to happen in the course of the next couple days. We're probably going to start to see stocks to move lower, and eventually that snowflake turns into a snowfall, turns into an avalanche, and then we have a stock market crash. And if you're looking for stocks to buy now, this is one that I'm going in on a big way, because the Federal Reserve will not be raising interest rates any higher. Therefore, interest rates will move lower. It's just a matter of when, and TLT stock moves up. I've been talking about this for about 2, 3, 4 weeks as I've been slowly getting into this position, and I expect it to continue to move upward over the course of the next several months as we get more and more economic data. Make sure to hit that like and follow button. If you want written content, written analysis on the economy, how it affects the stock market, I have a Substack newsletter. Link is down below in the description. We'll see you in the next video, and I will continually update this position with a stock market crash. We'll see you.